Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today's Thursday. It's August 4th. Boy, oh boy, oh boy. August is just getting started, and I'll tell you, it doesn't seem like a traditional trading summer. Usually summers are really quiet. There's not a lot of volatility. There's not a lot of happening. We've got war. We've got Pelosi. We've got the Fed. We've got war in Ukraine. We've got just about everything on the table. So this is not a typical summer, not even close. It's about 8:10. Market's going to open up in about an hour and 20 minutes. The futures are kind of flat. Not really much going on right now. And also, before we get into today's session, there's two big reports coming out today. This is not a big week, heavy week reporting period, but we've got international trades in goods and services. I'm hoping that the number is going down. Look at the prior month, 85 billion. We're looking at 81 billion. I'm hoping that the number is declining. Anything above this consensus number, I'll be okay with. But I want to see a narrowing. Advanced data on good side in June showed narrowing of nearly 6 billion in deficit. So I'm hoping that this number catches some of that and will be down closer to about 80 billion. That's the first report that comes out. The second report that comes out, and both of these reports come out in about 19 minutes. So you will see these reports right around the time the video release. So you may want to check the market because a lot of things are going to change between 8:30 and 9:30 depending on how these reports come out. Jobless claims have been kind of steady, not really anything major. As long as we're near the 4-week moving average, that's all I care about. And honestly, the numbers are not anything worth, going crazy over. We've got enough things in the world to be freaked out about right now. So anything about 250,000, I'm not too concerned about. I'm a lot more concerned about the international trades in goods and services being closer to 80 billion versus being around 85 billion. Now, the bond market. We got to talk a little bit about the bond market. Now, as you can see here, the bond market has been rather choppy lately, and I've been using this opportunity to sell bonds anytime we get above this level. And the reason is because I don't think the long bond is going to go higher. Long bond going significantly higher would mean a reduction or a stasis on the current interest rate environment, and I don't think that's going to happen. Matter of fact, I think the Fed is going to keep raising rates, but it's being priced into the market, so I think the bond market is going to stay choppy. I think it's going to kind of stay within this range, or maybe kind of go a little bit up or maybe a little bit lower, but kind of stay in this range till we get a little more certainty from the market. So I'm taking advantage of this opportunity to sell bonds anytime we're near the 120, 121-ish level and covering them here. We've had a trade just a few days ago. We had another one that we closed out yesterday, and I have an order in for another one right now. So if we remain near these levels, I'm going to be selling them because I don't think they can sustain this level. I think they're going to be rather choppy and sideways. Now, the interesting part is a lot of the stock sectors adopted that trading style. For example, look at discretionary. Communication sector, look, down, choppy, right? Just waiting for directional bias because the interest rate environment has a lot to do with consumer communication, technology, and where's that consumer discretionary sector? And I think these are way overdone. So I believe what's going to happen is we're going to see some downside, and we're going to see a reversion of the sectors that have been leading on a quarterly basis. 6-month, 3-month, 1 month. If you look at the 6-month, you'll see energies, utilities, but technology's getting up there. But look, technology's here, but consumer discretionary's here. They're getting out of whack. And whenever you see technology and consumer discretionary stay away from each other, because these things are like milk and donuts. They go together real well. So whenever you see technology and consumer discretionary moving apart from each other, that means markets are getting fragmented and they're getting a little overdone. On a monthly basis, you could see that consumer discretionary and technology has been rallying because earnings have been outpacing estimates because estimates have been so darn low. But I'm not big on the monthly flow. I'm more on the cumulative flow. Excuse me, it's a little early to talk still. But I would still focus on energies, utilities, healthcare, consumer staples. I would be very careful going long consumer discretionary and technology right now. I would be very, very, very cautious doing that. In terms of volatility, volatility looks like it might have bottomed out. I'm expecting volatility to start moving a little bit higher. There's just not much more to go here. And I think with the uncertainty in the market and with all the negative data that could be coming our way and may be coming our way, we're going to have a lot more pain than pleasure. So in my opinion, I think it may be time to go long volatility, and that's something we may be doing in the near term. Now, with that said, let's look at the major indices and see where we're at. Now, this is way, way, way too much. We're almost at that 8.6 CPI level. The question is, are we going to hit it and bounce off of it, or are we going to go higher? I personally think we're going to cool off. I think this is too much too fast, and the market needs to cool off. That's my personal opinion on that. If you look at the QQQ, we are way, way, way past that area. But again, I think we still have way to go. Remember, this index got beaten down more than anything else. And I think the majority of what we're seeing is going to cool off, and we're going to see some downside. I think it's too much, too fast, and I think the markets are getting ready to cool off a little bit. Now, if you look at the Russell, and if you look at the small caps, you will see that they're also starting to do the same thing. But look at how lagging they are compared to the Dow. They're more like the Dow than the QQQ. And remember, the Russell, when things turn around, they start leading. Right now, the Russells are not leading. The QQQ's leading, and that's because earnings are just so darn good compared to estimates. Estimates have been beaten down. But look, it looks like it's also looking like it's ready to cool off. So I'm expecting volatility to increase. I'm expecting the market to start recognizing that this is just too much too fast right now. In the next couple of months, it may not be. That depends if earnings continue moving higher. Now, earnings have been pretty good so far, really good so far. But today we've got Square, and they're expecting 17 cents. That's not a lot at all. They're expecting negative 74% year over year on slightly less revenue. I think they're going to beat this number. I think this number is going to be better than negative 74%. I think it's going to do exactly what all the other stocks are doing, outperforming the estimates. But on the revenue front, I'm not so sure. I think this is actually pretty reasonable here. It doesn't look all that out of whack, negative 6.4, but this is too much. I think they're going to be like negative 50 or 44. This is too much. And tomorrow we have DraftKings. And again, I believe the market is just way, way overdone. I think it's going to start cooling off. I think we're going to start reverting back to the cumulative and away from the general. And again, it's the big, big clues that technology and consumer discretionary are away from each other. Now, today is Thursday, and Thursday we pick ETFs. And right now, the ETF that I'm really liking, that I'm really, really focused on, and I know you guys are gonna say I'm crazy, but I really like the healthcare. I think healthcare can really rally right now. Or if you're not a fan of healthcare, you've got consumer staples. In terms of the cumulative, you've got consumer staples and healthcare. So, and on a monthly, you've got consumer staples, and healthcare is all the way at the bottom. So I think for now, let's stick with consumer staples, okay? Let's stick with consumer staples, especially with the defensive market we have right now. And if we want to go to consumer staples, CF right there. Either CF or CDNS. Those are the top stocks. I wasn't promising to give you the top stocks, but here we are. But I would stick with consumer staples. That's XLP ticker symbol. I think you cannot go wrong with that right now. I think it's getting ready to break out, and it's consolidating around here. It's not as overbought as everything else. It's slowly making its way here. So I personally, what I would do is I would look for options right now that are around December. You got plenty of time. It's at 75 right now. I would be looking at probably, let's see here, where's the volume? I would wait till the end of the session and go with the 76 or the 67. 76 or 77, not 67. 76 or 77. I would wait for the market to wait till we're almost done and then put them in if you're going to do it. But I like where they're at right now. I'm starting to get a little bearish on volatility, and I think the markets are getting ready to go a little bit lower before going higher again. I'm just being realistic with you. Now, before I let you go, folks, a few weeks ago, I released a new strategy, Pattern Trader. So far, it's dominated. It's quickly becoming my favorite strategy. It doesn't use fundamental analysis or technical indicators. Instead, focuses on that's right, 5 chart patterns that historically work based on back testing. And since I started publishing pattern trades, guess what? We've had 11 signals, and guess how many winners we've had? What do you think? 11. All 11. One of them was a bonus trade, but yes, 11. And today we're going for number 12. I'm going to issue a trade right around noon sometimes. Join me 1 p.m. Eastern time. That's right, Thursday, the 4th of August, 1 p.m. Eastern time, today. Bookmark the link below and jump in early to reserve your seat. Remember, this is the only place you'll get access to my new way of trading. You'll find out what the backtest data is on these 5 strategies. You'll find out which have been hitting. I'll show you the track record. You really need to see this. You really, 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 really need to see this. It's really good stuff. It's very different than what you're used to. It doesn't take market direction, volatility. It's just pattern based. So you could trade it in a bull market, bear market, choppy market, volatile market, quiet market. It doesn't matter. It doesn't matter. We let the patterns do the talking. Follow the link below. And if you're on YouTube, follow the link in the descriptor. But you got to get in on this. Follow the link below. And it's the only place to get access to Pattern Trader. Check it out. The info in this class, it's worth its weight in gold. We spent a lot of time researching it. I don't want you to miss out. I'll see you later. Keep your eye on the Fed. Bye.